Avoid crypto tax mistake number 2, the fictitious gains dilemma by Crypto Blocko. This is part of how to avoid 7 costly crypto tax mistake series. All right. Your goal is to go to crypto bullseye. Our goal is to help you get there. I'm your host, Kirk Phillips, the Bitcoin CPA. And a quick disclaimer, remember all of our content is for informational and educational purposes. This is not tax advice, investment advice, or legal advice. I'm a CPA, but I'm not your CPA. Tax advice cannot be provided unless there's an official engagement letter. Anyway. All right, so the fictitious gains dilemma. Now, cost basis determines the size of your tax bill, and it can be the single biggest factor in the outcome of the size of your capital gains. And people can get tax wrecked using the wrong cost basis. Of course, we know about people getting wrecked in crypto from losing assets or getting rug pulled, but this is a special kind of wrecked, getting tax wrecked. All right, so fictitious gains can be the biggest culprit of getting tax wrecked. Now let's just do a quick cost basis review. Simply the inventory for calculating gains. That's what cost basis is. It's just an inventory method. The same as inventory methods are used for counting goods in a retail store when you see stores taking inventory. So you have to know what your tax jurisdiction allows. Just because you've got a list of cost basis methods in particular crypto tax software doesn't mean you can just use any of those. So you have to know what your jurisdiction allows. So cost basis examples are FIFO, LIFO, CCFO, which is closest cost first out, then average cost, and of course spec ID or specific identification. Now, of course, there's many other variations of those and so forth. These are just some examples. In the US, for example, you can use FIFO or specific identification. And of course, we could have a deep dive in these cost basis methods, which we'll do in other videos. So you have to watch out for the FIFO method. All right, so watch out for FIFO. What does that mean? Well, there aren't an infinite number of trading pairs. All right, so you must buy Bitcoin or Ethereum first and then buy XYZ coin, for example. So an infinite number of trading pairs simply means that whatever coin you can dream up that you have that you want to sell and whatever coin that you want to buy, that there's actually a match on whatever platform it is. So there's a limited number, even though there's very, very many of them, there's still a limited number of them. All right. So basically BTC and ETH are a gateway to other coins, or you could think of it as a conduit to other coins. So there's a trade in the middle that sometimes has to take place, and that trade is what creates a gain. So let's take an example of what that looks like to make it more clear. So Bob gets tax wrecked. Bob bought 10 BTC for $12,000 in 2016, which means it's $1,200 per Bitcoin. Then on April the 1st, 2021, Bob buys $5,000 in Bitcoin. And then he buys $5,000 of XYZ coin with the new BTC. So basically he goes to his favorite exchange. He wants to buy XYZ coin, but he finds out, oh, the only way that I can buy this is I got to buy Bitcoin first because I can't buy it with USD or basically there's no other choice. So Bob can only buy XYZ coin with BTC. Now he doesn't want to use his old BTC in cold storage because he's got that secured. So he simply buys the $5,000 in Bitcoin. 10 minutes later, he sells that and buys the XYZ coin. So he'd actually never wanted to even buy Bitcoin in the first place. All he wanted to do was buy XYZ coin. That's it. A simple buy with cash that he had available. All right. So moving along, FIFO sells Bob's old BTC, creating a fictitious gain. Now, notice how we have sells in quotes because FIFO really doesn't do the selling. Bob does the selling. It's that when you do the tax calculation, FIFO, so-called, does the selling based on the FIFO methodology, which is first in, first out. So it means the oldest coins in Bob's inventory, the 10 BTC above, that's what gets sold first. All right, so this is the crazy fictitious gains. FIFO calculates a gain on the purchase of crypto, and you say that's impossible. You can't have a gain when you buy an asset. That doesn't happen in any asset class. Gains only happen on sells, not buys. So how does this happen? Well, again, FIFO would look at Bob's the 5,000 new BTC, right? That he bought, and then this is the gain calculation minus the $120 of the old BTC. So the $5,000 new BTC minus the very low basis old BTC equates to a $4,880 gain using FIFO. All right, so how do you avoid these fictitious gains? Well, for example, let's look at CCFO, which is closest cost first out. And of course, there are derivatives of this like highest in, first out, and so forth. Okay, so CCFO would match Bob's economics when he buys XYZ coin. So let's look at the calculation. $5,000 of new BTC minus the $5,000 of new BTC equals a $0 gain. So basically the 10 minutes in our example where Bob bought the BTC just long enough to then buy the XYZ coin, which is what he actually intended to do in the first place, this method matches the economics of Bob's situation. That's why the in-between, the hop, the conduit, the middle transaction, whatever words you want to call it, that in-between hop, buy, sells, an economic wash. And this CCO methodology, for example, helps to match the economics of Bob's situation. All right, so what you need to do is examine your trading style. For example, do you make lots of trades on lots of different exchanges? In that particular case, most likely to trigger the fictitious gains dilemma. Do you use BTC and ETH in those middle trades, those conduit trades like we just talked about? So what you need to do is really increase your trading awareness. This is the first thing. And when you trade, be thinking about how many times you either buy BTC or ETH going in, or by the way, this is also an example. This fictitious gains dilemma can also happen when you sell. We just used the buy example to illustrate how extra crazy this is, because you should never have a gain on a buy. So that's why we illustrated the buy, but the same phenomenon can happen on a sell. All right. And the other thing to do is find out which cost basis that you've been using. Perhaps you don't even know when you're watching this video. But the thing is also to point out here, FIFO isn't necessarily bad, unto itself. It really is something that is for particular trading styles and just particular uses of crypto. I'm saying trading. Don't think of yourself necessarily as a trader, but you could be an investor. But whatever the case is, whatever your investing / trading style is, it could be possible that FIFO is the pitfall. So, but that's not always the case. FIFO could be beneficial for someone. So just don't take it that FIFO is unto itself, something to stay away from. It can be in some cases appropriate for and the best method for particular situations, but you got to watch out for this dilemma. So the number one thing you need is a process, a plan, a roadmap, a blueprint. That's what you got to have when you're doing crypto. And that's true for crypto taxes or really crypto anything, crypto investing, crypto security, etc. So remember, your goal is always to get a crypto bullseye, and our goal at Crypto Blocko is to help you get there. And of course, an investment in knowledge pays the best interest. Benjamin Franklin. So look out for part 3 of this 7-part series.